All right, everybody, welcome back to Talk Tickers. Today we're doing a deep dive on Stratasys Q3 2024 earnings call.
Yeah.
They've been around forever in the 3D printing space, but what's really interesting to me is the fact that they're showing signs of resilience in this crazy economy.
It is pretty interesting. I mean, a lot of companies are struggling right now, and they reported a return to non-GAAP net income profitability, even though their revenue was down year over year to $140 million.
That's what I'm talking about. Not just treading water, they're actually making moves. I mean, we're seeing this softness everywhere in capital equipment spending right now. So how are they pulling this off?
Well, it seems like their focus on operational efficiency is paying off. They specifically mentioned that they were achieving improved gross margins and reaching the highest points since Q4 2019.
Okay, so they're tightening their belts.
Huh.
But what about the top line revenue might be down, but there's one figure that really popped out at me: 8 consecutive quarters of year-over-year growth and recurring revenue from consumables.
Right.
What does that tell you?
Well, that tells me that their customers are really embedded in the Stratasys ecosystem. So even if companies are hesitant to buy big new 3D printing systems in this economy, they're still using their existing Stratasys machines, and that means they're buying consumables, which is a steady stream of revenue, and that's pretty resistant to economic swings.
It's the classic razor and blades model, except this razor makes jet engine parts.
Exactly.
But let's dig a little deeper. They mentioned this growth in consumables was driven by their FDM technology utilization. So what's the takeaway there?
Well, it seems like FDM is their workhorse. It's reliable, versatile, and clearly delivering value for their customers. But I think more importantly, it points to a larger trend that companies are moving beyond using 3D printing just for prototyping. They're actually integrating it into their manufacturing processes.
So they're not just making models, they're making real functional parts.
Exactly. And that shift is crucial because it means 3D printing is becoming an essential tool for businesses across a whole bunch of different industries.
Absolutely. And speaking of industries, Stratasys is laser focused on some high growth areas. Automotive, defense, aerospace, medical devices, and dental. They even highlighted their new F3300 industrial platform designed for superior performance and faster print speeds.
Yeah. And they already snagged some major customers for that platform: Toyota, BAE Systems, Nissan. So they're targeting the top players in these industries and winning them over.
Okay, that's impressive. But it's not just about the hardware. They also launched the Origin 2 printer and Origin Cure post-processing system.
Yeah.
What's so special about this system?
Well, it's targeting short-run production with injection molding quality. And they specifically mention connectors as a compelling example. Connectors often have really high manufacturing costs and relatively short production runs, and this is where additive manufacturing can really shine.
So they're offering a solution that's faster, more cost-effective, and potentially higher quality than traditional methods.
Yeah.
That's a game changer, especially for industries that need to be agile and responsive to, these changing demands that are happening all the time.
Absolutely. And let's not forget their strategic initiatives for ensuring profitability, and especially in this tough environment. They've already completed a 15% workforce reduction ahead of schedule, and they're really focusing on eliminating implementation barriers for customers to drive adoption.
Yeah, and those are tough decisions to make, but they're committed to navigating this downturn strategically. And it's not all about cutting costs either, right? They're still seeing positive indicators within the market. They mentioned robust utilization rates of their existing systems and a growing interest in additive manufacturing solutions for specific use cases.
Yeah, that's a key point. I think it suggests that even though the overall market is soft, there's still underlying demand for what Stratasys offers. So they're not just riding out the storm, they're actively positioning themselves for future growth.
I'm seeing a pattern here. They're not just reacting to the market, they're shaping it.
I think so.
And they're betting big on some major mega trends, like onshoring, supply chain resilience, and customization. I mean, these trends are only going to accelerate in the coming years, no matter what happens with interest rates.
Absolutely.
It's like they're playing 3D chess while everyone else is stuck with checkers.
Yeah.
But what really surprised me? They mentioned that their software, like GrabCAD Print Pro, is generating a ton of interest. In fact, customers are even asking to use it with competitors' machines.
Interesting.
What do you make of that?
That is pretty remarkable. It tells me that their software isn't just an add-on. It's a valuable tool that can really enhance that entire 3D printing workflow, regardless of the hardware.
So they're not just a hardware company anymore. They're becoming like a solutions provider.
I think that's a good way to put it.
And speaking of solutions, let's talk about Trudent. Their solution for dentures. It sounds like they're making some serious waves in that industry.
Yeah, it's fascinating. They're leveraging 3D printing to create dentures that are faster, more precise, and more aesthetically pleasing than traditional dentures. And they're actively working to expand Trudent's reach both geographically and in terms of applications.
It's like they're not just selling a product. They're building a whole new approach to denture care that's disruption in action.
I agree.
They're targeting expansion into Europe and Asia, collaborating with leading institutions and even government bodies to demonstrate the value of this technology.
That's right.
Okay, we've covered a lot of ground here, but there's one more thing I want to touch on before we move on to part two. Their outlook for the rest of 2024, they seem pretty optimistic, even in the face of this challenging market.
They're forecasting a positive outlook, and they expect to achieve an 8% EBITDA margin in 2025. Even without revenue growth and with moderate growth, they believe they can hit 10%.
Wow, that's some serious confidence.
It is, but it's not unfounded. I mean, they're backing it up with concrete actions and a clear understanding of where the market is headed.
So they're not just weathering the storm, they're preparing to come out swinging when things turn around.
Exactly, and that's something to keep in mind as we delve deeper into their financials in part two.
We'll be back soon with more insights, so don't touch that dial.
Welcome back to Talk Tickers. Last time we left off, we were just amazed at Stratasys' ability to not just survive, but thrive in this shaky economic landscape.
Yeah, it's like they're defying gravity while everyone else is like bracing for impact. But remember, we're here to go beyond the headlines and really dissect what's making them tick. And for a company like Stratasys, that means diving deep into their financials, particularly their recurring revenue.
Yeah, you're spot on. That recurring revenue, especially from consumables, is the lifeblood of their business. I mean, what really struck me was the consistency of their growth in this area. 8 straight quarters of year-over-year growth. That's not just luck, especially in this market.
Okay, I'll bite. What's the secret sauce? How are they pulling this off while others are floundering?
Well, I think it boils down to 2 things: a smart business model and strong customer relationships.
All right, break it down for me.
Okay, so first, their business model. It's perfectly aligned with the growing adoption of 3D printing for actual production, not just prototyping, as companies increasingly integrate Stratasys technology into their workflow. They inevitably need more materials, more consumables. It's like a snowball effect. More usage equals more revenue.
So they're not just selling a product, they're selling a process, a way of doing business.
Exactly. And the second piece of the puzzle is their customer loyalty. Stratasys has spent years cultivating strong relationships, providing top-notch support, and training. This translates into repeat business customers sticking with what they know and trust even when times get tough.
It's like that old saying, a happy customer is a repeat customer. But hold on, we can't forget about their software, which is becoming increasingly important to their success.
You're absolutely right. While they haven't disclosed any specific numbers, both the CEO and the CFO emphasize the strong interest in their software offerings, particularly GrabCAD Print Pro. And remember that intriguing detail we discussed earlier, customers wanting to use it with competitors' machines.
Oh yeah, I do. That was a head scratcher. Why would customers go through the hassle of using software designed for one brand on a completely different brand?
Yeah, that's the million-dollar question. And I think it suggests that Stratasys has hit on something special. Their software isn't just an accessory, it's a game changer. It's so good, it transcends brand loyalty.
So they're not just a hardware company anymore. They're a software powerhouse too, and high-margin software revenue. That's music to any investor's ears.
Absolutely. It adds a layer of diversification and resilience to their business, which is, crucial in this unpredictable market.
Speaking of resilience, let's talk margins. Stratasys managed to improve their gross margins, significantly reaching 49.6% in Q3. That's pretty remarkable considering the current economic headwinds.
It is. They've been laser focused on cost optimization, and those efforts are clearly paying off.
Tough decisions like the workforce reduction aren't easy, but they're, sometimes necessary to stay ahead of the curve.
I agree. And they're not just slashing costs blindly. They're streamlining operations, strategically allocating resources to their most profitable areas. It's about working smarter, not harder.
Plus, they're benefiting from a favorable product mix. More revenues coming from high-margin items like consumables and software. It's like they're playing chess while everyone else is playing checkers.
Exactly. But here's the million-dollar question. Can they sustain these margins? I mean, the economic outlook is still uncertain.
That's the nail biter, isn't it?
Yeah.
It seems like they're doing everything right internally, but a lot depends on external factors they can't control.
You hit the nail on the head. Their future success is going to depend on how the market recovers. But their dedication to cost discipline and their strategic focus on those high-growth industries does give them a significant advantage.
They're not just weathering the storm, they're building an arc.
Before we wrap up part 2, I wanted to touch on something that really piqued my curiosity during the earnings call, their mention of exploring asset monetization. Yes. They were a bit vague on the specifics, but it definitely suggests they're actively looking for ways to leverage their assets to create more value for shareholders.
Knowing their history of strategic acquisitions, it makes you wonder what they have up their sleeve. Could they be thinking about selling off certain divisions or intellectual property, or maybe they're eyeing a new acquisition to bolster their offerings?
It's all speculation for now, but it definitely adds another layer of intrigue to this already fascinating story.
Well, folks, we've unpacked a lot about Stratasys, their robust financials, their strategic vision, even their cryptic hints about asset monetization.
But the real question is, what does all this mean for you, our listeners? We'll be back soon to synthesize all these insights and answer that very question in part 3. Don't miss it.
All right, everybody, welcome back to Talk Tickers for the final act of our Stratasys deep dive. We've journeyed through their resilient financials, explored their strategic bets on high-growth sectors, and even pondered those intriguing hints about asset monetization.
Yeah, we've covered a lot of ground. It's been like piecing together a puzzle, revealing a company that's not just weathering the storm, but actively shaping its future.
Exactly. So let's shift gears a bit and talk about what all this means for you, our listeners, especially those of you who are, keeping a close eye on Stratasys as a potential investment.
Right. So here's the bottom line. Stratasys is demonstrating all the hallmarks of a company that's built to not just survive, but thrive in the long term. They're not just passively waiting for the economy to rebound. They're taking charge and making strategic moves to capitalize on the future of manufacturing.
It's like they have this unwavering belief in the power of 3D printing, and they're betting big on its continued growth. But it's not just blind faith, is it? They're backing up with a solid track record of execution smart investments and a keen understanding of the market.
Yeah, absolutely. They're walking the walk, they're controlling costs, investing in innovation, and laser focused on the markets with the most potential for 3D printing adoption. And they're not just a hardware company anymore. They've evolved into a comprehensive solutions provider with their software and services playing an increasingly vital role.
That's what I noticed too. It's not just about the printers. It's about the entire ecosystem that they've built around them. And that's a powerful differentiator. I mean, take their Trudent solution, for example. They're not just selling dentures. They're revolutionizing the way dentures are made and delivered.
Yeah, it's a textbook example of disruption. They're taking a traditional, often cumbersome process and turning it on its head, making it faster, more precise, and more patient-friendly. And they're not stopping there. They're actively expanding Trudent's reach, both geographically and in terms of applications.
That's the kind of forward-thinking approach that really makes them stand out. They're not content with the status quo. They're constantly pushing boundaries and exploring new possibilities, but they're also pragmatic, aren't they? They're not afraid to make those tough decisions like streamlining their workforce to make sure they stay agile and efficient in a challenging market.
Yeah, it's a delicate balancing act, and they're managing it masterfully. I think they're proving that you can be bold and ambitious while also being fiscally responsible and responsive to market conditions.
It's like they're playing 4D chess while everyone else is struggling with checkers.
Yeah.
Now, before we wrap things up, I have to ask about that, tantalizing hint about asset monetization. It's like they dropped a bombshell and then walked away.
I know, right? They didn't divulge any details, but it's clear they're exploring ways to leverage their assets to unlock even more value, whether it's through strategic divestitures, licensing agreements, or even acquisitions. It's definitely something worth keeping a close eye on.
Talk about a cliffhanger. But hey, that's what makes following a company like Stratasys so interesting. They're always keeping us on our toes, always pushing the envelope.
Indeed. They're a company that's not afraid to challenge conventions and disrupt industries. And for investors, that can translate into some pretty exciting opportunities.
All right, folks, that wraps up our deep dive into Stratasys. But before we sign off, it's time for the moment you've all been waiting for, our This Is Not Financial Advice segment. Ready to have some fun.
Always. But remember, everyone, this is purely hypothetical and for entertainment purposes only. Please, please do not take this as actual financial advice.
Okay, disclaimers out of the way. Let's get wild. We've established that Stratasys is a force to be reckoned with, a company that's not just surviving but thriving in this crazy market. They're profitable, they have a rock-solid balance sheet, and they're attracting those major players in key industries. So what if, and hear me out, what if Stratasys becomes like the hottest acquisition target in the 3D printing space as the market rebounds?
That's an interesting thought. It's not entirely far-fetched. I mean, their strong financials, their strategic positioning, those innovative solutions could make them an incredibly attractive target for a company looking to dominate the market or, gain a foothold in those high-growth sectors that we've been discussing.
Exactly. Imagine a company like HP, Google, or even Apple deciding that Stratasys is the key to unlocking their 3D printing ambitions. The potential upside for investors who got in early would be, well, let's just say it'd be very exciting.
Yeah, it's a scenario worth pondering, but again, we're just speculating here. It's all fun and games until somebody actually makes a move.
All right, everyone, that's it for our Stratasys deep dive. We hope you found it insightful and thought-provoking and maybe even a little entertaining. Remember to do your own research and, as always, invest responsibly.
Until next time, keep those stickers talking.